Okay, we'll go ahead and get started with this. I really appreciate everybody jumping on. Again, I know how near and dear time is on your schedule. So as we get started, I want to make some introductions. Obviously, I'm Bert Copeland, founder of New Life CFO Services. And also on this is Lola Copeland. She's actually our Director of Operations and Marketing. Lola, you want to say hi real quick?
Gonna make me unmute. Hi.
So Lola is going to be monitoring your questions as you put them into the chat. So whenever we're going through this entire presentation, I welcome you to put your questions into the chat because we're saving about 10 or 15 minutes towards the end to really jump into your questions. And as you'll see at the end, I'll say you can ask me anything. Not anything personally. We're not going down that rabbit hole, but you can ask me anything about accounting and finance, and we'll tee it up and get going. A little bit of my background is, as I mentioned, I'm the founder of New Life CFO Services. And what that is we do outsource or fractional CFO. We do outsourced accounting services from bookkeeping to outsourced controllership. And we also help companies in preparing their way to a better exit. Me personally, I have a very eclectic background, which in this, relative to what I do, that's a good thing. So I'm a CPA, MBA. I worked in public accounting. I've been a controller, a CFO, a business owner, obviously founder of New Life CFO, which means that I've done a startup from bootstrapped it up. And I've worked at companies from as large as 30 billion down to 30 million. Currently, we have clients that range from 1 million to 25 million on the accounting side and from 5 million to 80 million on the CFO side. In total, currently, we have about 675 million in revenues under management. Now, you don't have to show me a quick show of hands on this, but I always think it's great. So I know how invigorating accounting can be for a topic, especially to a group of entrepreneurs. So how many of y'all honestly woke up to say this morning and says, man, I just can't wait to jump on a big Zoom call and hear about accounting techniques and processes for 45 minutes. I know that I can't see everybody's screen, but I'm sure it was a uniform. Everybody absolutely raised their hand, or at least Cindy did. But anyways, as we start going into this, I really appreciate your time because for me, and yes, I'm an accountant at heart, but this is really a very important topic. And it's so important that we actually broke it into a couple of different topical segments. So as we go through this, we have 4 different things that we're going to address. Today, we're looking at what is the ROI of good accounting and what are the symptoms that says that your accounting may not be as healthy as you think it is. And then we have some of these ongoing programs on the 3rd Friday of every month. And in May 19th, we'll be doing accountant qualifications. How good is the staff? Are they really equipped to do your deals? And what does reporting excellence look like? In June, we'll pivot over into accounting systems and processes, some snare traps there, especially if you're migrating systems. And then lastly, on July, we're going to look at accounting black holes and fraud prevention. Accounting black holes really has to do with some companies and some industries have very esoteric kind of accounting, and we'll dive really deep into that because if you're one of those industries, you'll really want to be honed in on joining us for those topics. But today, as we start off on the ROI, one of the key questions that I get into a lot for the ROI is, what is the ROI of accounting? So if I were to ask the average entrepreneur is, give me a couple of words to describe your view of accounting, right? As far as the department. Some of them are going to be necessary evil, overhead, jargon-filled morass that's somewhere in the back office. But it's usually seen as that necessary evil. It's a function I have to have. It's not one I want to have per se. Kind of reminds me back when I was an auditor in back then it was Big 8 public accounting. But, I always describe auditing as being skinned alive with a butter knife, because every time you went into a client, the first thing they wanted to ask you is, when are you leaving? Sometimes that's the same perception that CEOs will have of their accounting function. But honestly, Your accounting function should be one of your biggest allies in your business. I mean, it should be attached to your hip. And that doesn't mean that's irrespective of whether it's your bookkeeper or you're large enough to have a CFO. That should be really your sidekick. Another way of thinking about it, a good accounting, bookkeeping, or CFO really is like the navigator that's in the cockpit with you as you're flying your jet. You know where you want to go. They're going to help make sure that you get there safely and that everything is working well. So with that said, here's some basic topics that we're going to cover as far as where the ROI really exists for you and your deals. So how many of y'all have ever watched Shark Tank? Right? I'm sure we all have. That and The Profit are two of my favorite business shows. But what's the number one thing that they talk about in Shark Tank? Or the number one frustration that the sharks talk about the entrepreneurs that are presenting? Well, it's you don't know your numbers, right? In some cases, they flat out just don't know their numbers. In other cases, they don't know what their numbers are telling them about their business. And of course, we can always think about Jim Collins on Good to Great. And we all remember the chapter that says, the chapter about your financials. I think it goes something like, data schmata, who cares about the numbers? Just make decisions with your gut. I get it. That chapter doesn't exist. Nor does that chapter exist in any book that you're going to read about outstanding business practices. So while it's easy to say, you know what, I just don't speak the language as my accountants, and so I don't want to engage, it's quintessentially important that you understand those numbers, because that's where the real ROI comes from. Now, as far as ROIs, let's talk about leading indicators of where you really get your ROI. Number one is that adage that we use of you can't make good decisions on bad information. It's impossible. If you're given bad information, the likelihood of you making bad decisions is almost 100%. The same thing is true as if you make decisions based on late information or misleading information. All those things add to your inability to make good decisions about the direction and priorities of your business. The next big thing where people really get sideways is really, how many of y'all ever read the E-Myth? I'm sure every hand went up because this is a very entrepreneurial group. But within the E-Myth, it talks about this lady that starts a business, I think either cooking cupcakes or cakes, and she's great at it. She loves that. But as her business grows, other things get wobbly, functions that she's not all that familiar with. And what does she do? Like every entrepreneur does, she dives in to fix it, right? So how does that affect the ROI of accounting? Well, here's why. Time suck. If you're the entrepreneur, you probably started your business because you were outstanding at sales, or you were outstanding at operations, like you built a better mousetrap, or whatever the case may be. You're a beast in the sales channel, built a better mousetrap, and that's really where your God-given gifts are. So what does that mean if you're in a time suck? It means that time is being pulled away from the things that really make you special, that really allow you to drive your business forward. We had this one client point in time. I'm just going to call her Gail because I'm not going to mention her business. And Gail is one of the most engaging human beings you'll ever meet in your life. I mean, like over a conference table, it's probably the funnest meeting you're ever going to have. But she had a very unique business, and she started it because she was a beast in the sales channel. And we were talking about her business and why it wasn't growing as much. And she kind of started complaining about, well, my salespeople, they're just not producing as much as they could. I don't understand why the numbers are so low. There's just opportunities everywhere. And how could you only produce X? And I go, well, why do you say that, Gail? And she goes, I personally could produce twice as much as my number one salesperson. And I said, well, what's preventing you from doing that? And she started going down this litany of pain stories about how much time she has to spend on the admin, how much time she's having to spend on correcting the accounting and the billings and working with customers and all that. And I said, Gail, I have some great news. She goes, okay, what's that? I said, for $65,000, we're going to get you the greatest salesperson you've ever thought of in your life. She goes, that's impossible because no salesperson is going to work here for $65,000. I go, that's correct. However, we can get a really great office manager that also knows bookkeeping, a really good one for about $65,000, and free you up to go and sell. And that was worth $2+ million a year to her. And she was about a $6 million business. So it was a big thing. Her not having to be involved in the accounting represented a $2 million benefit just by her avoiding the time suck that she was actually incurring. So what are some other areas where we have great opportunities to improve the ROI for accounting? Well, the time suck theory does not just apply to you being the business owner. It applies to your sales and operations team. How much time are they spending either chasing bad numbers or clarifying bad numbers, or how much time are they chasing having to do cleanup work in their own operations that are caused by bad numbers or bad accounting processes? Here's a good example. We have a large construction client in Texas, and when we re-engage with them, they are having horrible problems. Their margins are coming down on their projects. They're kind of bleeding cash. They're really short on cash flow and everything else. And so we sat down with all their operations folks and says, where are you spending your time? And lo and behold, they're spending 20 to 25% of their time on chasing vendors and contractors to get to the job site. And why is that? Because they weren't able to pay these people timely. Therefore, those folks weren't readily coming to the job site. And you back that up just a little bit more. And what was really the root cause? The folks in accounting who had undergone a change in personnel had changed the way and the processes of billings. Billings had gotten really jacked up. Billings were very slow. Collections were even slower. So the company was starved for the cash it needed to pay everybody timely. And as soon as we fixed that, which only took about 90 days for all that to right size, once we got that done, guess what happened? The operations folks now had one extra day a week to focus in on their projects instead of focusing on the chasing circus that they did for all their contractors and vendors. It also allowed them to be very proactive about chasing change orders, and their margins went from 8-9% up to 15% to 18% to 20%. And in their industry, they are now at the upper quartile of margins and profitabilities. So that's where we kind of get into that whole time drain and highest and best use. So when you look around to your people and they're telling you about their frustrations, ask yourself, is some of the root cause related to what's going on in accounting and the chasing that it has to do to either get the numbers right or the ramifications of bad numbers going out in the marketplace? So ROI number 3, big number 3, selling your business. I'd love to see a show of hands, but how many of y'all, when you started your business, I'm going to start this business and either grow it to where it can just be shooting out cash all the time, or grow it with the idea that I'm going to sell it, harvest those resources, do something else, or do another business, whatever. Most entrepreneurs start their business to someday sell it. Now, someday, maybe 3 years from now, maybe 5 years from now, maybe 30 years from now, but going to sell it at some point in time. The number one reason that companies don't go from I want to sell to deal is bad accounting. Number one reason. Because if you're looking at your business, I will tell you right now, when other people start looking at your business, accrual accounting, good, clean accrual accounting is the gold standard for being able to sell your business, right? So what happens when that's either going on or not going on? Let's say that you have your letter of intent out there and people start looking at your business and they start jumping in. Well, if the accounting's bad, then what starts to happen is all these questions start percolating up, and questions by possible buyers and their attorneys and their accountants and all the blah, blah, blah people that run around are not good. They're not good. Number one, we're back to a time suck. It's going to take you away from your business, which sometimes can adversely affect your business. It'll start nosediving. But more importantly, is those issues start to raise questions in the potential buyer's head about what you really know about your business and how structurally sound is it. And as those questions get raised, their confidence goes down. And when their confidence goes down, so does your price. So does the likelihood that you even get a deal. So just a little fun fact here. If you took 100 companies on average that put themselves up for sale, do you realize that only 20%, some say 17%, but only 20% of those businesses actually get to a transaction? Let that sink in for a little bit. We're saying that 80% of them fail. So even out of that 17%, 20 to 17% that do succeed, it's a small fraction of those that sell at a premium. So you want to talk about the ROI of really good, strong accounting? Think about what you need to do to exit and exit well. It's worth the investment. It's pennies on the dollars when you start looking at that. Another area where you might be looking at it is if you want to get a loan. It's kind of like wanting to sell your business, but it's all about raising capital. And so when you look at your business, I don't think you're looking at it with the same viewpoint that your bank looks at it. In fact, your banker view of how you look at your business is going to be very different from your view. So when your banker looks at your business, they're going to look at EBITDA. They're also going to look at your balance sheet, which is a weird separation for most entrepreneurs. Now, when I speak live with entrepreneurs, I ask them a question. It's like, when you get your financials, what is it that you look at? And they will tell you flat out, well, if I look at three things, it's going to be revenue, it's going to be my bottom line or EBITDA, and I'll look at my cash balances. Some of them will actually say margin, which is good. Other than cash, though, nobody says that they're looking at their balance sheet. Nobody. Which is really weird, because that's where the bank is going to go first and foremost. Because they're going to look at your balance sheet, because the balance sheet really tells them more about your business than your income statement ever will. So when you look at your balance sheet, something to keep in mind is how your balance sheet really works. Your balance sheet really works like this. When you open the doors to your business, the first thing you do is you put cash in, and it's equity. The last thing you do in your business is you take cash out, and equity goes to zero. So keep that in mind, because everything in your business is rolling to and away towards cash. It starts with cash and it's going to end with cash. That's true with everything on your balance sheet as well. The other thing that I want you to understand is if your balance sheet is jacked up, I will tell you flat out, there's no way that your income statement is correct. No way. So if you think about those auditors that we talked about earlier on that are being skinned alive with the butter knife, in audit, a typical auditor is going to spend 80 to 87% of their time banging away on your balance sheet. They will look at your income statement, because the philosophy is if your balance sheet is correct, then your income statement is correct. It just may be in the wrong place on the income statement. So we call that, let's make sure the balance sheet is correct. And then the rest of this is just geography. Because if the balance sheet is correct, your income statement is correct. So for all of y'all that are not looking at your balance sheet, I will tell you that there is a high probability that your income statement is wrong, that you're looking at things that aren't really true. And it's especially true if it's you and your accountant kind of looking over that. Now you might ask me, why is that? Well, here's why. I don't know if you realize it, but you and your accountant, y'all have different DNA, right? The average entrepreneur is brash, proactive, probably an extrovert, and out in the marketplace and always pushing towards the future. Usually a pretty big personality in the room, quite frankly. And that's almost the exact opposite of your accountant. Your accountant tends to be, hey, there's a reason I went into accounting, because I didn't want to be out in the world shaking hands and kissing babies. I like to do my work. I like to do my work and know it's done well. And then that's the end of my day. If I can do that a lot of times without talking to people, better yet. I used to joke around on occasion that sometimes a controller likes to sneak in under the cover of night, place the financials on your desk, try and sneak out without ever being caught. But y'all have radically different personalities. So when problems appear on the income statement and you're like, what is that? That can't be right. Make that go away. The accountant's also typically conflict avoidant. So they're going to, okay, I need to do something like that. And all that's happening is trash is starting to build up on your balance sheet, right? So you need to have, if your accountant is not really taking you through the balance sheet, that is also a symptoms that you have sickness going on in your accounting deal. because when things start accumulating in your balance sheet, it means that they're no longer moving towards cash. Something is stuck. And that's not good, because I will tell you that anytime that somebody is really not paying attention to their balance sheet, anytime that we go in there to do a cleanup, anyone want to guess how many times that comes out favorably? 0. So for all of y'all that picked 0 as the answer, dead on, you're absolutely right. Because what can happen, just oddly, is when those trash starts to build up, the accountant starts getting nervous and they'll try and push, well, we need to correct this. We need to push that into the income statement, which only leads to, oh, no, that can't be right. Because the numbers get bigger and bigger over time, which means the problem in your balance sheet gets bigger and bigger. And it also means that what you're seeing on your income statement is distorted more and more. So another symptom that we just talked about is your accountant, your controller, your bookkeeper needs to be walking you through the balance sheet as well. I'm not asking you to become a CPA, because we're going to go into some tricks that you can implement later on. So here's some other signs that you have problems in your accounting, that it may not be as well as you think. Volatility. As if your numbers are bouncing around, I've been so busy talking, I haven't been advancing my slides. Somebody should have pinged me on that. So here's where we were talking about the symptoms. And when we're getting the symptoms and everything else, what we're really talking about is the red flags. Golly, I need to be better about not getting so wrapped up in my own talking, or having somebody else advance the slides for me. And where we are right now is on this part. What represents good symptoms related to your business? Stammering's never a good thing, and I'll try and stop it right now. So as you're looking at your business, one of the other things that is a leading indicator of you have a problem is volatility in your numbers. And that's when they're starting to just bounce around. So the primary place that you want to look for volatility is your gross profit percentage. Now, you may have big revenues one month and low revenues, but hopefully your gross profit percentage stays within a very close band of, okay, it's 33%, it's 32%, it's 34%, a very close band. But if it goes from 50% down to 15% to 40% to 30%, all that kind of stuff, that is a huge issue. And it's telling you that you have real problems in your accounting processes, people, or shop. So what's normally the cause of something bouncing around like that? Well, I will tell you, in a lot of businesses, it's one of 3 things. It's almost universally one of 3 things. Number one, you have poor execution. Whatever's going on in your operational shop, whatever that looks like, whether it's a plant, whether it's a distribution center, whether it's a bunch of professional services, you are not executing well. Number 2, what that volatility tells you is that whatever you're proposing on is inaccurate. It doesn't reflect how work actually gets done. So you're proposing on something at 50%, it's going 50%, 50%, boom, 20%, because you have problems in your proposal process. The other thing that it really tells you when it comes down to the ROI of accounting is your accounting shop is jacked up, that their processes are jacked up, and their timing about how they're using and accounting for the numbers is jacked up. That's especially true in organizations where accounting and operations really have to live together tightly. And I call that a dance, right? So your operations and your accounting folks need to be dancing very closely together without stepping on each other's toes, right? So if you hear your operations people niching about your accounting people, you probably have a problem. If you have your accounting people niching about your operations people, you probably have a problem. And I will guarantee you, when those problems exist between those 2 entities and they're not communicating well, not serving each other well, the odds of your numbers being jacked up, real high, real high. The odds of you making bad decisions, real high. So hopefully that kind of helps you out on why those things are done. And again, keep in mind that when those problems start to occur, they're usually being dumped in the balance sheet, and those problems get bigger and bigger. We actually had one client, when they finally cleaned up their balance sheet, they thought they had made $50 million, and they lost $40 million because their balance sheet was totally jacked up. So when we talk about your balance sheet, here's some other things that you can think about. Keep it in mind that your balance sheet should always be rolling towards cash. So if something gets stuck, like it continues to grow, you need to be asking about that, right? One of the key areas to look into is intercompany balances. They make me sick most of the time. They're usually jacked up. But if those intercompany balances are really moving up, you have transactional problems that your accountants are not solving. And it probably means that something should have been flushed through your income statement and hasn't been. So those things really represent a very big risk as you're looking at it. And then as we're looking at some of your other items, as far as where the problems come in, let's just make it as simple as close. When do you close your books? Are you closing your books on the 5th? That's fantastic. Are you closing your books on the 10th? Well, that's pretty darn good. Are you closing your books on the 15th? Like not closing your books, but also having a financial summit where somebody's explaining that stuff to you. That's pretty good. But if you're closing your books like on the 20th or 25th, I will guarantee you have problems in accounting. Not only that, because the information is getting to you so late that late information is almost the same thing as bad information. But here's how a great accounting shop would work. So if I only have 30 days in a month to do accounting, the closer I get to close being done in the first 10 days, it really allows me to now have 20 days to work on optimizing the processes, doing analytics. But if I'm spending all my month on just closing, it means I'm not improving anything. I'm scrambling like a banshee trying to get stuff done, and that is not good. Because when you're scrambling, you're going to take shortcuts. When you take shortcuts, things get jacked up. When things get jacked up, the numbers are wrong. So close is probably the first indicator. Another great indicator to keep in mind that's up here is your frustration level, right? So as you're frustrated, that means that you have really issues going on. Another big issue, and it's one of my favorites on these variances, is ideally your accountant should be providing you with multiple months if they give you your P&L, it should be this month and last month, year to date this year, year to date last year, with some variances and explanations. If they're only giving you 1 month, that's not good. That's not good, because it doesn't allow you to compare and contrast, because it's the comparisons that really become meaningful. It's even worse if you're closing slow and you're only getting 1 month. Because if I'm your accountant, it'd be real easy for me to put the adjusting entries in a month that you're not seeing. But if you see the comparison months, you're going to see that. And in fact, for me, the universal rule that I use for all my accountants is if you have a correcting entry that has to be made, or you find some error that has to be done, you have to put it in this month. I have to see it in this month. You can't put it in some other month. Because we have to see it and we have to talk about it, and we have to determine what kind of process is broken that caused that. May not be in the accounting shop, but we're going to have to talk about that. That actually represented an issue to where a past client, when we got involved, their controller was doing that to purposely hide money from the CEO as far as errors, so that their bonus would be higher, because the CEO thought that they were doing much better than they really were, because they were only showing current month. Another deal is what I call the when your accounting team becomes the manager of never-ending minutia. You know, the way I describe this is problems within your accounting shop should not become an alien life form of their own. We had another client that we were working with, and their inventory was a mess, a flipping mess. And so their very loyal bookkeeper was working on cleaning up the inventory. Anyone want to guess how long that was taking? I think it went on 2 to 3 years trying to clean it up. And why is that? Great lady, well-intended, was going back to all the detailed transactions and trying to clean up the transactions to clean up inventory. The problem is you can never catch up on that. The best way to clean up inventory is like, we're going to call King's X. We're going to go count the stuff. We're going to retabulate it, reprice it, and that's our inventory. And that allows us to have a clean slate going forward. But when you have problems that are always ongoing in your accounting shop and seems to continually be the delay and why things do or do not get better, you got a problem in your accounting shop, right? Your processes are broken and you're lacking the leadership to help the rest of the team understand how to fix those processes. They may or may not be 100% in the accounting shop, but your accountant, your bookkeeper needs to be helping to explain how that's affecting the business, affecting the numbers, affecting your ability to make a decision. So that's a really good way of looking at it. We've talked a lot about the balance sheet, so I'm not going to spend as much time talking about that, but in a little bit, we're going to talk about some of the things that you should really be looking for to make sure that your balance sheet is all done properly. I'm not asking you to become a CPA because God knows that's not what's in your long-term vision or plan. But as we move away from the balance sheet, the last thing that I will touch on is the balance sheet is not easy for non-accountants to really understand what's going on. And I will highly encourage you to develop a list of KPIs to help you to monitor the health of your balance sheet. KPIs on a balance sheet are so much easier to understand than the nuances of your balance sheet alone. Because the balance sheet is really important because of its interrelationship with the income statement. So if you don't have good KPIs, ask your bookkeeper or accountant to help develop those so that you can understand what healthy looks like. And if they can't do that, then you may have a problem, right? You may have a problem. For some of them, quite frankly, you may be in a smaller business, you have a great bookkeeper, they're doing good at bookkeeping. They might not have the experience to help you out on those KPIs. And if so, reach out to a good financial friend. Obviously, you can reach out to a fractional CFO company, but get those things down there and have somebody explain why those are important and set targets for what a healthy metric looks like and monitoring whether you're there or not. That's a really important thing to get into. Now, the last section here is delays, procrastinations, and problems. Processes matter, especially in accounting. So here's a huge indicator. We've already talked about close not being done on time. But one of the other big indicators is people saying, oh, they're asking you about transactions that happened like in the first week of the month. Why are we talking about those now versus talking about those in the first week of the month? Like when my memory was real clear about what the heck happened. So typically when those things are going on, it means that there's all kinds of mess, catch up and clean up, and maybe panic and pandemonium going on in the accounting shop. So they're not processing the daily transactions on a timely basis. I'll get caught up on Friday. I'll get caught up on Monday. I'll get caught up on next Friday. Always working to get caught up. So here's another universal rule that I always put in place, and it's very simple. Yesterday's transactions have to be posted today before anybody goes home. Very simple. And what that does is it keeps the snowball from growing in size. Now, you'll have to work with the rest of your company, because what that means is, hey, when the accountants get in from 8 a.m. till 12, nobody talk to them because they're making sure that yesterday's stuff is all processed today. And that includes payroll, AP, disbursements, billings, receipts. All that stuff is processed on the day after it's done. And if you do that, and you do that well, it's a very simple way of making sure that close happens on time. And in fact, it's probably the best way to make sure that close happens on time. Other things that can really go sideways is procrastination and problems, is things leading up to the close. Y'all may not have heard of such a beast that I'm getting ready to mention, but it's a really important beast, and it's a close calendar. And you're like, oh my God, here goes the accountant geek talking about close calendars. Like, who cares about that? Well, your accountant should. A close calendar kind of works like a launch pad or liftoff deal. Okay, so it's T minus X minutes until the rocket takes off. Your close calendar works the same way. We're going to deliver financials on the 10th, which means that on the, typically it means that on the 1st or 2nd that we're closing out billings. On the 3rd, usually on the 1st or 2nd, you're closing out accounts payable and costing. On the third, you're closing out billings. On the fourth, you're closing out inventory, so on and so forth. So you have little mini closes about what has to happen along the way. And that information is distributed to the company because frequently you have people like in the warehouse that have responsibility to do it, in inventory control that has a responsibility, in billing that has a responsibility to do it, in whoever's processing the invoices that are coming in. Everybody has a responsibility, and the close calendar helps to make sure that those things are happening uniformly. In fact, in a really good company, some of what happens in close happens before month end. So now we're going to flip over into some things that you can be doing to help make sure that you understand your balance sheet and that you can kind of monitor it. So when we're talking about monitoring the health of your accounting deal and helping to make sure your accounting folks are being held accountable. So typically, if you're to read a textbook, they're going to tell you about internal controls and separation of duties. Like your accountant shouldn't be doing everything. Well, for a lot of the companies on this call, you don't have that many accounting people. So you can't have separation of duties. So how do you make sure that there's good oversight about what's going on so that you, as the business owner, know what the wizard is doing behind the curtain? So here's some tips and tricks. Number one, you want to make sure that they are reconciling cash every Monday for the previous week's activity. It's real simple. It probably would only take them an hour every Monday to get that done, but it also makes sure that all your transactions are not only accounted for, but they're posted. There are no dangling chads that we have to go chase at the end of the month. All those things are there, they're posted, and everything else. What that does for you, it means that anytime that you open up your books, they are pretty timely about what you're seeing. And the only things that are missing are the accrual and accounting entries that are not there yet. But it's a really good way of week to week, making sure that the data that you look at in your accounting shop, if you want to monitor sales, you want to monitor margin, whatever, those things are pretty timely. So making sure that that cash is reconciled weekly, you'll be stunned that with the yesterday's transactions all posted today, you will probably take 5 days off your close and immediately pick up utility about the numbers getting to you on a good and timely basis. Some other things that you can do as far as monitoring the health of it. So my metaphor here is like your security system for your home. Do you know that statistically speaking, what one of the most important thing is to deter criminals from coming into your house? It's not the security system. It's the sign out in your front yard. The mere fact that you're telling people that you have a security system is the #1 deterrent for making people pause and walk away from your house to go to somebody else's. So let's use that metaphor as how you might be able to monitor and govern your own accounting shop if you don't have enough people to have proper separation of duties. #1, ask questions. You need to see, just like you see a variance report on your income statement, you need to see a variance report on your balance sheet and ask questions for those variances. Why did that number change? What's going on there? On occasion, and you don't even have to know what these things look like, ask to see the bank reconciliation. If you're going to ask to see any reconciliations at all, and again, you might have them explain it to them. I'm not saying you're walking away as a CPA, but just the fact that they stand and deliver in front of you and have to describe those reconciliations, you're going to immediately know whether those reconciliations are worth a flip or not. But as you look at those reconciliations, you don't have to look at them all, right? You don't have to look at them all. But I will recommend that on occasion, just ask for, I want to see the bank reconciliation. I want to see the reconciliation of AR. I want to see the reconciliation of AP. I want to see the reconciliation of our accrued liabilities for payroll, sales tax, and payroll taxes. Because those things get jacked up, you got a big problem. And then lastly, ask for the reconciliation on inventory. Those are most your working capital accounts. And why am I specifically focused on those? 2 reasons. #1, there are specific schedules that those things tie to. Pretty easy to see if it works or not. Pretty easy to see if it works or not. #2 is those things drive your working capital, has the most immediate impact on your income statement. So if those things are jacked up, I will guarantee you that your income statement is jacked up. So on occasion, just ask for them. You don't have to understand them, but you can see it makes sense or it doesn't pretty easily. Really good reconciliations are extraordinarily easy to follow. The only other one that I might throw in there is your prepaids, because stuff can get stuck in there pretty quickly. So just ask for those things on occasion. A great way of kind of monitoring this without being a CPA is ideally, your folks have a reconciliation log. And I know that sounds like just a whip, but let me explain what that really means. They should list out, here's all my balance sheet accounts, right? Then here's the balance per the books, and here's the balance per the supporting schedules or subledgers. The delta, if there is a difference, there should not be. But if there is a difference, then they explain it. And so in 10 minutes, if you have that sheet, you could go down there and go, hey, it looks like everything's reconciled. Thank you very much. You might ask for that before you get your financials, right? It's a very powerful way of making sure that your accounting shop is done well, because every really good controller is going to have that and have it readily available. And if you have even I've seen companies that have CPAs as controllers that don't have that. And I will guarantee you that the balance sheet was really jacked up. So just because the person has the right initials after their name doesn't mean they're doing the right things. If you ask for these very simple items, you will see a tremendous turnaround, just having the accountability, the separation of controls, and everything else. So lastly, we're going to just touch on reporting before we kind of open things up for the questions. When you get your financials, I'm going to ask you to do one thing that is critically important for your ability to assess A, what's going on in your company, and B, how good are the numbers. You get your financials, I want you to set them down and do not look at them. Don't turn it over. Don't look at the first page. Don't go look at revenue. Let them sit there at least an hour. Go to lunch. But I want you to be thinking about, what do you know happened in your business during that month? You might even keep a log. I've seen some people keep a log, little book like this, things that happen in their business throughout the month. Thumb through that. You know what you're doing? You're setting your own expectations about what you should see in those financials. And when you enter the financials and open that first page, you now can ask outstanding questions about, well, wait a second. I thought we had that huge sale and shipment that went out on XYZ date. This looks like average numbers. What happened? Well, you may find out that they didn't book it in time, that didn't ship in time, or that there was a big offset that offset that otherwise you'd never see. So don't look at your financials for an hour, maybe even a day, and then have your list of questions, your mental questions. Then when you look at it, draft out your questions and start taking those back. Questioning those people, you will definitely find out if you have a sick accounting shop. As soon as you ask those kind of very intelligent questions, you will find out that the wizard is really a wizard, or it's just somebody behind a screen pulling a bunch of levers. With that said, now that we've gone through this, I want to open it up for any questions, and Lola may have something. And while you're thinking about some of your questions, everybody that's invited to this, and we do these on the third Friday of every month, and on the second Friday of every month, as you kind of digested this, we're going to have another LinkedIn Live called Ask Me Anything. So use that QR code, scan it. You can get registered for it, and register whether
you need to advance the slide, hon.
Oh, I didn't advance the slide. Thank you.
Sure. And there's nothing in the chat box right now.
Okay, well, that's good. Either everybody fell asleep or is just so overwhelmingly informative that they don't have any questions, but I think they probably fell asleep. But anyways, you can see our QR code. Go ahead and scan that. It'll allow you to register for the Ask Me Anything. And in doing so, you can either come with any questions, you can submit them in advance, you can just try and surprise me, but we're going to go through accounting and financial management, and truly ask me anything. I'm a pretty good impromptu actor, but I don't mind being embarrassed either. So with that said, Lola, if you have any questions, or if people want to raise their hand about questions, I'll give a few moments of silence and then let y'all think through some stuff.
I don't know if everybody's muted or if they can unmute themselves. I think they can if they have a question. But I'm not seeing anything in the chat box right now.
Okay.
Are you able to hear me, Bert?
Yes.
All right. Hey, just out of curiosity, how much time do you typically have to spend kind of educating your client CEOs on the basic elements of finance?
That is a great question, John. It depends. We do dive into that quite a bit. We tend to pivot towards dashboards and metrics.
Mhm.
Because, part of our role, quite frankly, is what we'll refer to as Chief Financial Education Officer, helping people to understand what their numbers are telling them about their business, and what actions or behaviors, if they take them, will change that number.
Mhm.
But it's a growing process, right? It doesn't happen in a magic wand. We do look at numbers very differently than the average bear, but just part of what we do. Great question, John. Thanks for asking.
Yeah.
Charles has a question. You mentioned KPIs for the balance sheet. Do you have those someplace where we can get those?
Yeah, I'll tell you what, I have recommended KPIs and a spreadsheet that I can send everybody. And it'll tell you what the KPI is, what it's kind of measuring, how to calculate it. And then a spreadsheet will be attached. If you want to load your data into a financial spreadsheet, have at it. You might give that to your accountant as a little bit of a test and, hey, can you get this stuff done? Happy to send that out though. Charles, I'll tell you, there's a couple of my favorite KPIs for a balance sheet that we'll just go ahead and cut into because we have a few minutes. One that you've never heard of before, because we made it up, is called OPLIC, operating liquidity. And what that is it's AR plus your cash divided by your average monthly COGS and operating expense. And what does that tell you? It tells you the number of months that you can operate your business on your two most liquid assets, which is why we call it OPLIC. But what it's also telling you that if you should have at least 2 months of OPLIC between those two assets, preferably 3, because what that allows you to do is understand if I stub my toe and my business gets disrupted, then I have 2 to 3 months of cushion to correct things before it gets into a crisis. Not having that, and we've seen some companies only have 2 weeks of OPLIC. Any stub toe immediately sends the company and its management team into chaos. My other favorite metrics all have to do with the working capital. And that's days sales outstanding, or called AR turnover. Days in payable, I'll call it AP turnover. And days in inventory. Those 3 things combined get to your cash to cash cycle. How many days does it take from when I buy inventory to I sell it and collect it? That is one of the most crucial metrics you will ever have, especially on the days of inventory. I will tell you, people get really excited about their inventory. And my universal opinion of inventory is a write down waiting to happen. And if you overinvest in inventory and you haven't well, it's still good, it's still sellable. Your customers are telling you that's not what they want. They're not willing to pay you for that. So those things really affect the liquidity and cash cycles of your business. And I could go on and on. The sheet has several, and we usually pivot and design KPIs for specific companies depending on their stress at that point in time or their opportunities. Lola, anything else that has come up?
Yeah, Steve has a question. Do you find that poor accounting is typically a capacity or a capability issue?
Yes. Sorry, Steve. So sometimes it's a capacity issue. So really good accountants sometimes can get lost in the weeds of that minutia, managing the minutia. And what they need is for somebody to come in there and go, whoa, whoa, whoa. Let's go find the root cause of this. Let's solve the root cause so you can stop chasing broken transactions. We had another client recently, and they had a lot of broken transactions that the accounting team was constantly cleaning up. They were literally spending 65% of their time cleaning up broken transactions. Once we discovered that and got back with the operations team and started cleaning up how those processes that generated those transactions, the capacity was renewed, Steve, so that they then had time to reinvest in doing things right the first time. Capabilities, that happens too. You know, if you hired the guy out of your Sunday school class because he was in between jobs to be your bookkeeper, but he's not a bookkeeper, you got a problem. The other thing that we see as far as capabilities is a term that I call title inflation. Not real inflation, but it's just as dangerous. So here's how title inflation works. 20 years ago, I hired a capable bookkeeper, Bob. Bob's very loyal, works very hard. I give him raises on occasions, but my real pat on the back to Bob is I give him a promotion. And how do I promote Bob from a bookkeeper to bookkeeper class 2, class 3? No, I make him accounting manager. And then I make him assistant controller. And then I make him controller. And then I make him CFO. But at the end of the day, what I have is a bookkeeper that knows my business really well. Title inflation does not help. And that starts to cloud what you really have and maybe what you really need. Let me see. Steve, since it usually costs more to do it cheaply than it does to do it right. Steve, I need to have you submit questions all the time, buddy. Do companies scrimp on accounting because they consider it to be overhead? Think bookkeepers or admin assistants can do it or just understand how important and complex all the time. All the time. Just because you have an idle body does not mean that they're ready to do accounting. Some people can have the affinity to move into accounting, but for those out there that are not familiar with either predictive index or culture index, if you have this person that you think might be able to become an accountant, have them do those indices, because there are certain profiles that you don't want in your accounting because it'll never get done right. And your predictive index or culture index person can walk you through that. But quite frankly, when I was in accounting 101, we could look across the room and we know who is not going to be in accounting 201, because it's a weird language and you either kind of get it or you don't. And the same thing is true of the admin assistant, the receptionist that you're going to ask to do accounting. Now, if you're just asking them to enter invoices into AP, that's pretty benign. But if you're actually asking them to get involved with closing out the books and preparing financial statements, that's probably a slippery slope. So great question, Steve.
Hey, Bert, how often do you see where companies' systems are actually not well suited for their businesses?
That too is a good question. John, we're going to specifically address systems, I think, in the third one, but it happens more often than you think. I will tell you universally, people that sell ERP systems are some of the greatest salespeople in the world. You may need a bicycle, but they're going to convince you to buy a Bentley. The other thing that I see is people thinking that they can create their own accounting system. And what I will recommend on accounting systems is go with tried and true. So for me, like, and I'm fine with bashing this, Zoho, great CRM, came out with Zoho Books. I'm not sure I want my CRM company designing my accounting system. And I'll tell you, it shows. The same thing is true with Financial Force that was built by Salesforce. I don't need my salespeople designing my accounting system. However, I could look at things like NetSuite, been around for a long time, really well done. I could look at QuickBooks for smaller companies. And what's really important about these things is, yes, it's a pretty good system, but they have tens, if not hundreds of thousands of users that are constantly giving them input about what works and what doesn't. Another great system, John, to think about if you're ever looking at good systems is any of the ones that are done by Microsoft, which could be Dynamics, GP, or whatever the case may be. And here's why: they're so well penetrated in the marketplace that when you hire new people into your company, they've probably seen it before. They already know how to drive that bus. But if you're the only user of your accounting system that you know of, it's probably going to be a problem because they don't have enough users to help push the corrections that you need to constantly make sure that that thing is doing its best. Did that answer your question, John?
You mean like SAP Business One?
You know,
Sorry, I'll shut up now.
No, that's fine. I like a little discomfort, John, so thank you. I'll tell you, I don't like Sage. I consider Sage to be a data prison. You can get stuff into it, but it's a whip to get it out. With one exception, Sage Intacct, which is a software system that they purchased, is a pretty darn good system. Hopefully Sage doesn't, quote, Sage it up, and it stays as good as it once was.
No, and I wasn't meaning that in a critical way. It's just, I just came from a situation where SAP Business One was way too much, and it
Oh
showed.
my gosh. Back in the day, I don't know of anybody that actually implemented all of SAP, and that's after spending sometimes hundreds of millions of dollars. But yeah, it's really careful to step back on a system and says, what do we really need? Because when a system has a ton of bells and whistles, most people don't use them. When a system requires you to re-engineer your processes to have those processes mapped in the system, most people don't do that. So you end up with this tremendous promise that never becomes reality. Well, at this point in time, I've consumed y'all's hour, and I want to thank you just over the top about spending this time with me. Hopefully it has been informative, and hopefully it has not been the most boring discussion of accounting that you've been in, and you don't rue the day. With that said, thank you very much. Be sure to hit the QR code and sign up for our Ask Me Anything. We're looking for a pretty lively deal, so don't be shy. Thanks for your time today.
Thanks, Bert. Really appreciate it.
No problem. Happy to help.